and welcome back to With Sikhya. Let's imagine there's a new mobile phone being launched in the market with a price tag of rupees 40,000 that you really want to buy. And of course, you don't have enough funds for it. Let's figure out how you can earn an additional rupees 40,000 by investing in equity and mutual funds, assuming you are willing to wait 6 months to buy the new phone. While equity and mutual funds offer excellent long-term investment opportunities, generating a specific return, especially a substantial one within a short time frame, is extremely challenging and involves a high degree of risk. Now you may ask, why is it difficult? Well, number one, market volatility. The stock market is inherently volatile. While it can offer significant returns over the long term, short-term fluctuations can be substantial. Next is time horizon. 6 months is a very short investment horizon for equity and mutual funds. These instruments are designed to generate wealth over several years, not months. Risk. To achieve such high returns in such a short period, you would likely need to take on excessive risk, which could lead to significant losses. Earning rupees 40,000 in 6 months through investments in equity and mutual funds requires a combination of strategic planning, risk assessment, and market knowledge. Here are some steps to consider. Number one, set a realistic goal. Calculate the amount you need to invest to achieve rupees 40,000 in return. Understand that high returns are often associated with higher risks. Number two, research and select investments. Equity investments. Look for stocks with strong fundamentals, growth potential, and positive market trends. Consider blue chip stocks for stability and mid-cap or small-cap stocks for higher growth potential. Mutual funds. Choose between equity mutual funds, index funds, and sector-specific funds based on your risk tolerance and market outlook. Number three, diversify your portfolio. Spread your investments across different sectors and asset classes to mitigate risks. Consider a mix of high-risk, high-reward investments and more stable, lower-risk options. Number four, monitor the market. Stay updated with market trends, economic news, and performance reports of your investments. Be prepared to adjust your portfolio based on market conditions. Number five, calculate expected returns. Use historical data and financial tools to estimate potential returns on your chosen investments. Understand that past performance is not indicative of future results. Number six is risk management. Set stop-loss orders to limit potential losses. Avoid putting all your capital into high-risk investments. Let's assume you start with an initial investment of rupees 1 lakh. Equity investments. Invest rupees 60,000 in a diversified portfolio of stocks. Average expected return 10 to 15% over 6 months. Mutual funds. Invest rupees 40,000 in high-performing equity mutual funds. Average expected return 8 to 12% over 6 months. Expected returns calculation. Equity investments is rupees 60,000 into 12%, assuming a 12% return, will give you 67,200 rupees. Mutual funds, rupees 40,000 into 10%, assuming a 10% return, will give you 44,000 rupees. Now, the total expected value after 6 months is rupees 67,200 plus 44,000, which is equal to rupees 1,11,200. And your net gain would be 1,11,200 minus 1 lakh, which is equal to 11,200. The actual return amount may vary. These figures are subject to market risk. This example shows that achieving rupees 40,000 in returns might require a higher initial investment or more aggressive investment strategy, possibly increasing risk. Try doing the same calculation using higher initial investments to figure out how much money you will require to earn rupees 40,000. I have attached an Excel file for your reference. Now let me give you some final tips. Consult a financial advisor. Professional advice can help tailor an investment plan suited to your goals and risk tolerance. Stay informed. Continuously educate yourself about market conditions and investment opportunities. Be patient and disciplined. Stick to your strategy and avoid impulsive decisions based on short-term market fluctuations. Now, this is yet another way of earning through investments in stocks and mutual funds. I hope you find this information helpful. Make sure to share it with your family and friends so that they too can benefit from it. And let's not forget to subscribe to With Sikya for more informative content from the world of finance. Thank you for watching. See you in the next video. Till then, happy and safe investing.